What if I told you that most of the money in your bank account didn't actually exist until someone went into debt? Not printed, not mined, not saved, created out of thin air. Every time you take out a loan, swipe a credit card, or finance a car, you're participating in a system that literally expands the money supply. But here's the shocking truth. The same system that keeps people stuck in cycles of debt is also quietly used by the wealthy to build massive fortunes. So the real question is, are you being used by the system, or can you learn to use it? Today, we're debunking the idea that the government can just turn on a machine and print money whenever it feels like. We're going to break down how debt creates money in our current economic system. Have you ever stopped and asked yourself, what is money? The simplest definition we've been able to come up with is this. Money is a vehicle that conveys value. Most people perceive money as something physical, cash, coins, maybe gold sitting in a vault somewhere. But in reality, the vast majority of money today is digital, numbers on a screen. And more importantly, most of it is created through lending. Institutions like the Federal Reserve don't just print money and hand it out. Instead, money is largely created by commercial banks when they issue loans. Yes, banks don't just lend money, they create it. And the mechanism behind this is something called fractional reserve banking. Here's an example you can fully digest. Imagine you deposit $1,000 into your bank. You might think that money just sits there. It doesn't. Under fractional reserve banking, the bank is only required to keep a fraction of your deposit, say 10%, in reserve. That means they can lend out the remaining $900. Now here's where it gets interesting. That $900 gets deposited into another bank account, which allows another bank to lend out 90% of that amount. And this cycle continues. So your original $1,000 can turn into something like $10,000 circulating in the economy. Not because new physical money was printed, but because loans created new deposits. That's how debt becomes money. Now I know you might be thinking, whose idea was this? Believe it or not, this system wasn't invented overnight. It evolved over centuries, starting with goldsmiths in medieval Europe. People would deposit gold for safekeeping, and the goldsmiths would issue receipts. Eventually, they realized something. Not everyone came back to claim their gold at the same time. So they started lending out a portion of those deposits while still honoring withdrawals. This worked, as long as too many people didn't demand their money at once. That concept eventually became modern banking. Today, central banks like the Bank of England and the Federal Reserve regulate this system to maintain stability. So why use this system? The answer is simple. It's because it fuels economic growth. It allows businesses to borrow, expand, hire workers, and innovate. Without it, economic activity would slow dramatically. Let's make this practical. Say you take out a $20,000 car loan. The bank doesn't necessarily transfer existing money from someone else's account. Instead, it creates a deposit in your account, money that didn't exist before. Now you spend it. That money flows into the economy, paying car manufacturers, employees, and suppliers. And through the banking system, it gets multiplied even further. Stay with me. Another example, mortgages. When someone takes out a $500,000 mortgage, that's $500,000 newly created and injected into the economy. I know. It sounds crazy, but it's practically normal. This is why housing markets are so powerful. They're deeply tied to money creation. So the next time someone says owning real estate is one of the top ways to become wealthy, now you know why. Now there is a catch to this. Debt has to be repaid with interest. And here's the tricky part. The interest isn't created when the loan is issued, which means there's always more debt than money. This is why people can feel trapped, working to pay off obligations in a system that constantly requires more borrowing to keep going. If mismanaged, it leads to cycles of debt, inflation, and financial crises. Now here's where things take a shift. While most people avoid debt, wealthy individuals don't. They use it strategically. They borrow money to acquire assets that generate income, like taking out a loan to buy rental properties and using leverage to invest in businesses. They even finance assets that appreciate over time. Instead of using debt for consumption, like cars or luxury items, they use it to create cash flow. The key difference? Good debt versus bad debt. Bad debt takes money out of your pocket. Good debt puts money into your pocket. Because when your assets earn more than the cost of borrowing, you're effectively using the banking system to grow your wealth. Now, I will admit, when most people hear the word debt, there's always a negative connotation that's associated with it. But the next time you hear the word debt, don't just think of something negative. Think of it as a tool, a powerful one. Because in today's world, money isn't just earned, it's created. And those who understand how it works have a completely different relationship with wealth. As of currently, the total U.S. national debt is around $39 trillion. This is not by accident. The U.S. holds the most debt in the world, more than any other country, and yet remains the wealthiest by way of GDP. So you might be tempted to ask, how is this even possible? It's because the U.S. understands this system completely and utilizes it to build massive long-term wealth. If this changed the way you see money, let me know what you think in the comment section. Because the more you understand the system, the more control you have inside it. Don't forget to subscribe to the channel. Thanks for watching.